Hello class, Financial Foundation. So today I want to come to you and talk about a few things in our last few assignments. I've been reading through everybody's answers and some of their questions they had. So I kind of wanted to touch on a few of those. One of the things a lot of people were talking about was banks and how can banks charge so many fees for loans and fees for repaying, interest rates. When you have a mortgage, sometimes there's points, and there just seems to be a lot of fees associated with that. And part of that is banks are in the business of money. So when we put our money in the bank, they pay us an interest rate to use our money. Now, typically the interest rate they pay us is a very, very low interest rate. I think currently it's like 0.1% or 0.2%. It's hardly anything at all. And then they take that money and they loan that money out to other people, charging 5, 6, 7, 8, 9% interest for them to use that money. And that's how banks make their money. That's how they make a profit in order to pay for the services that they provide. So the amount of fees that you're charged, or the part that you pay for loans, is directly related to a person's credit score. So the higher your credit score, the more credit worthy they have deemed you, according to a whole bunch of statistics having to do with how many loans you've taken out, have you paid your bills on time, have you ever been late, those types of things. The higher your score, the more credit worthy you are, the less interest they charge you because they know that you will repay that money. On the other side, if you've had some missed payments, or if you have a lower credit score, or you have a harder time getting credit, they deem people at a more risk. And so the more risk you are when loaning money, the more that they're going to charge you, because just in case you default on a payment, or you get behind, or you can't repay your loan, they try to get more money, more fees out of a person like that. And so sometimes it doesn't seem fair, because if things happen, life happens, unemployment happens, there's layoffs, there's emergencies, things come up. Sometimes it's just forgetfulness, forgetting to make a payment. We can get behind on a payment or make a late payment or have issues that come up that hurt our credit score, and then it takes a very long time to increase that credit score or get that credit score back up. I do advise everybody to check their credit score. If you don't already know your credit score, you can go to Credit Karma and sign up and see what your credit score is. On Credit Karma, you can also see if there's any issues on your credit. If you're in default on something or somebody's trying to get money, you can check on those to make sure those are in fact your own debts and nobody else has used your identity or borrowed money in your name. So that's a good way to check on that. If a person has a credit card already, usually those credit cards offer a service when you sign on to your online banking where they will tell you your credit score. They kind of sublease with places like Credit Karma to tell you what your credit score is. So if you don't know your credit score, I would definitely look that up on a place like Credit Karma to figure out what your score is and what that means for you. There was also some questions about credit cards and the pros and cons of credit cards. So a credit card can be a good thing in that you can use plastic to charge when you are out and about by the day instead of having to carry cash. If a credit card is stolen, you can call the bank immediately and have it turned off. Whereas if you had cash on you and your cash was stolen, then it's gone. There's no way to recover that. Credit cards also, if you pay your entire balance at the end of the month, then there is no fees associated with that. So in essence, you could make all your payments all month long and then just pay at the end when you get paid. The downside is sometimes people tend to spend more than they make. So they're on that credit card, they're making all their bills, and then at the end of the month when they get paid, they realize that they charged more than they thought. And so they float that balance over to the next month. And that floated balance is what causes fees and extra charges. So there are good things about a credit card and bad things about a credit card. If you're the type of person that can use a credit card and have discipline and use it as needed, it can be a good thing. It can be a tool. But if you know it makes you spend too easily, then maybe using a credit card should not be your first way to use money, and deal with other types of money spending.